Okay, so if you notice here, I have written this down as E1 equals D1 equals $5. This is for the no growth scenario, right? Where we are assuming there is no growth in dividends. What is E1 here? E1 is actually earnings. So, where do dividends come from? Dividends actually come from earnings. So here is in general how this works, right? You have firm's earnings, right? And then part of the earnings might be paid out as dividends, right? Again, dividends are discretionary. Not all firms pay dividends, so some pay, some don't, but they come from earnings if they are paid out. So you have earnings or net income from which a part of it might be paid out as dividends, and other part is retained by the firm, right? And that portion that is retained by the firm, that is referred to as retained earnings. Let me actually switch this around. So this is 3, this is 2. So in this example, you have earnings of $5 per share, right? This company pays out $3 per share in dividends, and then the remaining $2 per share is retained by the company. Why do firms retain part of their earnings? Why not pay out everything as dividends? Earnings are retained to reinvest in the business. So if this firm has some growth opportunities, right? If it has some projects that would allow it to grow, then it would want to retain a part of the earnings to invest in those projects. But here in this case, we have a no growth scenario, right? This firm is not growing at all. If there is no growth, then there is no point in retaining any earnings. There is nothing to reinvest in, right? There are no reinvestment opportunities, and therefore a no growth firm, it will generate this $5 per share in earnings, and it will just pay out all of that earnings as dividends, right? Nothing is retained by the firm, so all the earnings are paid out as dividends. And because the firm is not growing, its earnings would remain the same each year in future, and it will just keep making $5 per share in earnings, and it will keep paying out that $5 per share in dividends. So earnings in this case are same as dividends because there is no retained earnings. All the earnings are paid out as dividends. Okay. So now in our constant growth model, right, we have three components. We have the dividend D1. We can actually compute the dividend D if we have D0 and if we have the growth rate. If I know what the current dividend is, I can estimate the next year's dividend if I know the G. K, as we talked about earlier, K comes from CAPM or other asset pricing model. So what remains is G, right? So we know D0, this is the current dividend. We know K. What is missing here is G. So how can I estimate the growth rate, right? So that's the next discussion that we are going to have. Actually, there's one thing that I want to talk about before we go there, that we said that dividends are growing at the rate of G, but it turns out that when in this constant growth case, when dividends are growing at this rate of 5%, even the stock price will also grow at the rate of 5%, right? The growth rate is not just for dividends, even the stock price will grow by 5%. So I can write down my total return that I expect to get from stocks. How do you make money from investing in stocks? Two components, right? One is the capital gains, the other is the dividend, right? So P1 minus P0 plus D1 over P0. Here it is broken down into two components. It is D1 over P0, that's the dividend portion, that's the dividend yield, and P1 minus P0 over P0, that's the capital gains yield, right? That's the return that you get from increase in price, right? Current price is P0 and future price is P1. So that is how I make money from investing in stocks, dividend yield plus capital gains yield. And in fact, dividend yield is actually same as or the capital gains yield is same as the growth rate because the prices are also expected to grow at the same rate as G. So I can write this as D1 over P0 plus G, right? And that is the expected return or the required rate of return. So So you have this equation, right? If you rearrange this, right, you will get basically this relationship. Okay, K equals d1 over d0 plus g, right? So this is just saying that we get what we expect from the dividend discount model. Dividend discount model tells us that our return from the stock is made up of two components, dividend yield and capital gains yield. Okay. Now, so talking about G, right, how to estimate the growth rate. So here's how we can go about estimating the growth rate. We can estimate growth rate as the product of ROE and B. So what is ROE and what is B? ROE is return on equity. Okay, so we'll talk about that in a minute. What is B? B is the retention ratio or the flowback ratio. What fraction of earnings are retained by the company? That is what B is. So in this case, for example, out of $5 in earnings, $2 are retained by the company. So B is going to be 2 over 5 or 40%, right? What fraction of earnings are retained by the company? That is the retention ratio or the flowback ratio, and that is what this B is. Okay. Now, if the firm is growing at a rapid pace, if the firm is expected to grow at a rapid pace, then it will retain a greater portion of its earnings, right? In fact, if you look at a lot of firms that are in a high growth phase, they do not pay any dividend at all because they have to retain all of their dividends or all of their earnings are retained. All right, so all high growth firms are expected to have greater retained earnings. So therefore, one component of growth rate is what fraction of earnings are retained by the company, right? And then once they retain the earnings, they have to invest it in the business, right? And when they invest in the business, at what rate of return can they make that investment, right? What is the return on reinvesting in the business? If the firm has a lot of high returning projects, very profitable projects, then the firm retains the earnings or part of the earnings, and it is investing in projects that generate a very high rate of return, then obviously that firm is going to be able to grow at a rapid pace. So that is what this ROE component is. ROE is actually return on equity. ROE is return on equity, and if you recall from your accounting classes, maybe return on equity is net income over total equity, right? So this is a proxy. I mean, this is the return that the shareholders expect on their investment. And what we are assuming here is that the firm can also find opportunities to invest in at that same rate of return that the shareholders are earning. Okay, so part of the earnings are retained by the firm, and then those earnings are reinvested into the business. How much is retained and how much you can earn from reinvesting into the business, you take the product of those two and you get the growth rate for the firm, right? So that's the intuition behind this relationship. Growth rate is the product of ROE and B. Remember, ROE here is a proxy. We are using return on equity, but if you have some other way of estimating the return on investment, a better way of estimating the return on investment, that is what should be used in this equation, right? We are just using ROE as a proxy for return on investment. So if a firm retains a lot of its earnings but does not actually invest in very profitable high returning projects, it's not going to be able to grow, right? So retaining is one thing, but the firm should also be able to invest in high returning projects, and that is also an important component of this growth rate, right? So G equals the product of ROE and B. Okay, so if we have this dividend discount model, right, we now have all the components. We have the current dividend. We know we can estimate K from cap M, and we know how to estimate G from this equation. Okay, so in this case, it should be clear that B is 40%, and therefore the dividend payout is 60%, right? 3 out of $5 is paid out as dividend, so that's 60%. So 1 minus the dividend payout rate is also the retention rate, right? So that is what I have written down over here. Okay, so here in this graph, what we are seeing is that we have comparing two firms. One is low reinvestment, one is high reinvestment. High reinvestment firm, so that has a firm that has a lot of growth opportunities that it is investing in. So it is paying less of a dividend today because it is retaining greater portion of its earnings. The low reinvestment firms, it does not have lot of growth opportunities today, so therefore it pays out a greater fraction of its earnings as dividend. So this low reinvestment firm, this pink line that you see here, that is corresponding to high dividend today. The other firm has low dividend, but because this firm with high reinvestment is expected to grow at a rapid pace compared to low reinvestment firm, at some point in future we would expect that its dividend would surpass that of the low reinvestment firm. So even though low reinvestment firm might have higher dividend today, we expect that at some point this high reinvestment firm would surpass that dividend by growing at a much higher rate. Okay. So here basically it's saying that if the firm is fairly priced, if the stock price is same as the intrinsic value, instead of V0, I can write this as P0, right? So price is the market price, V is the intrinsic value. I can use them interchangeably if they are same, right? So so this is D1 over K minus G equals P0. Okay. Now I want to talk about this idea of PVGO, present value of growth opportunities. What is a present value of growth opportunities? So can we put a value on the growth opportunities of the firm within this dividend discount model, right? Within that framework of dividend discount model, is there some way to estimate what is the value of growth opportunities of the firm? And it turns out that there is. Okay, so I want to use a simple example to illustrate this concept of PVGO or present value of growth opportunities. Okay, so that's right here. So I'm going to assume that there are two firms, A and B. Firm A is a no growth firm. All right, if it is no growth, meaning it pays out all of its earnings as dividends, it does not retain anything, it does not have any need to retain any earnings to reinvest in the business, it's not growing at all. So for this firm, earnings are $5 per share, and therefore dividends are also going to be $5 per share, pays out all the earnings as dividends. Okay, required rate of return is 15%, right? So what would be the value? Again, this is the no growth case, so the no growth model applies here, right? Earnings divided by K or dividend divided by K, it does not matter, earnings are same as dividend. So 5 over 15%, right? 33.33. This is actually the same example we had on the slides before. So for this firm, this no growth firm, the value is $33.33, right? Using the dividend discount model under the assumption of no growth. B is growth firm, right? So B is growth firm. It pays 60% of its earnings as dividends, and therefore it retains 40%. So its retention ratio, which we are calling as B, is 0.40 or 40%. So that is the only difference between A and B. A is no growth firm, B is growth firm, but otherwise they're identical. Earnings for A, $5 per share. Earnings for B are also $5 per share. Okay. Required rate of return for A is 15%. Required rate of return for B is also 15%. So they have same earnings, same riskiness. The only difference between the two is their growth rates, and therefore any difference in value between these two firms is because of their growth opportunities. Okay, so now let's do the calculation for B. Now B has earnings of $5 per share. It pays out 60% of the earnings as dividends. So if next year's earnings are expected to be $5 per share, what would be the dividend? Well, 60% of $5, so that would be $3. Okay, so this firm would have $3 in dividends. Its required rate of return is 15%. We know that ROE is 20%. So this is your return on equity, and because it pays out 60% as dividends, that means it retains 40%. So its B is 0.40, right? So we talked about that before. What is the growth rate? So again, we can estimate the growth rate using our model here, ROE times B. So 0.20 times 0.40, ROE is 20%, B is 40%. So the product is 8%, right? So this firm has a growth rate of 8%, right? Its dividends are growing at 8% rate in perpetuity. What would be the value for this firm? So for value, we can use the constant growth model. So that would be D1 over K minus G, D1 over K minus G. So 3 is the dividend for next year. K is 15%, G we estimated as 8%. So 3 over 0.15 minus 0.08, 15% minus 8%, and you get the value of this firm as 42.86. Okay, so here for no growth firm, we got the value as 33.33. For this growth firm, we got the value as 42.86. Because these firms are identical other than their growth rates, this extra value this firm B has is because of its growth opportunities, right? And that difference is what we refer to as the present value of growth opportunities. So if we assume that this firm B paid out all of its earnings as dividends, right? So it did not retain anything, it would become like firm A, right? And its value would be 33.33. But it is not doing that. It is actually retaining 40% and reinvesting in the business. And by doing that, it is actually generating higher value for the shareholders, right? It is creating extra value for the shareholders. And that extra value that is being created is the present value of growth opportunities. How much value can we put on the growth opportunities of this firm today, right? So without growth opportunities, its value would have been 33.33. With growth opportunities, its value is 42.86. Therefore, what is the present value of growth opportunities? The difference between the two, $9.53. All right, $9.53 is the present value of growth opportunities for this firm A. The extra value that it was able to generate is due to its growth opportunities, and that is the value of growth opportunities today, and hence the name present value of growth opportunities. So we can break down the total value of any firm into two components, right? So this is the total value of A or B, right? Sorry, this is the present value of B, right? PVGO for B. So total value for firm B is 42.86. Out of that, 33.33 is the no growth value, right? So this is if the firm did not pursue those growth opportunities and paid out everything as dividends, so its earnings are all paid out as dividends, then its value would be 33.33. So without growth opportunities, its value would be 33.33, and then whatever extra we have is the present value of growth opportunities. So 33.33 is the no growth value of the firm. Without growth opportunities, what is the value? And we can estimate that as E1 over K, right? If I take this $5 and divide it by 15%, I'll get the no growth value, which would be 33.33, right? So E1 over K is the no growth value, and PVGO is the present value of growth opportunities. So the total value of the firm is the summation of those two, right? And that is essentially what I have written down over here on the slides. P0, that's the total price, is the no growth value, E1 over K, plus the present value of growth opportunities, right? Or I can write PVGO as P0 minus E1 over K. Okay, so that is this concept of PVGO, present value of growth opportunities. Okay, and so I can write, like I said, I can write this as P0 or I can write this PVGO as P0 minus E1 over K, and I already know that P0 is this, right? D1 over K minus G. So D1 over K minus G minus E1 over K. So that would be PVGO, or D0 times 1 plus G over K minus G minus E1 over K. So either way you can do this estimation of PVGO. Now, one important thing to also remember is that not all growth opportunities actually add value. Growth is not the same as growth opportunities, and I want to illustrate that by changing some of the numbers here. All right, so then the only thing that I'm going to change here is ROE. All right, so let's say ROE is 15% or actually 10%. Okay, ROE is 10%. What would be the growth rate for this firm? It would be now, so everything else remains the same. The only thing that I have changed is the ROE. Growth rate is ROE times B. So now it is 0.10 times 0.40. So that would be 4%. Okay, that would be 4%. And then my valuation would look like what? So D1 is the same, right? I have not changed that part there. K is the same, but the growth rate now is 4%. So with the 4% growth rate, what do we get as the value of this firm B? I get 27.27. Okay. Now you see what has happened. The value is actually destroyed. Value of A, which is the no growth firm, is actually greater than the value of B, which is the growth firm, right? So that means, I mean, think about that. What that means is that had this firm B, instead of actually retaining 40%, had this firm paid out all of its earnings as dividends, then it would have become like firm A. Its value would have been 33.33. But in this case, by retaining part of the earnings, it's actually destroying value, right? It would be actually better off, or it would actually make or generate more value for the shareholders if it paid out all of its earnings as dividends and did not pursue this growth opportunities. So by pursuing this growth opportunities, the value is destroyed. What is PVGO in this case? So we have 27.27 now minus 33.33. So it is actually negative 6.06, right? Negative 6.06. Okay, negative 6.06. So present value of growth opportunities is negative here. Without growth opportunities, firm's value is higher. With growth opportunities, the value is lower. So this firm would have been better off just not pursuing those growth opportunities, right? So what changed here? So the firm is still growing, by the way, right? Remember, the growth rate is 4%. So the uh, the growth is still positive, right? Positive 4%, but the growth opportunities, the value of growth opportunities is negative. So what this is telling us is that not all growth is good or desirable. It's not like firm should go about pursuing any available growth opportunity. So what is the deciding factor? What is the key factor here? So this is the key factor here, right? ROE of 10%. That's actually the only number that I changed in this calculation. Instead of ROE of 20% before, now our ROE is 10%, right? 10% is not good enough. If the firm is only earning 10% on its investments, right, that is not good enough. Why is that not good enough? Because K is 15%. Okay, so that is really the key here. K is the investor's required rate of return. Investors want a return of 15%, but if the projects in which the firm is investing can generate only 10%, that's not good enough. Then investors' money or the required rate of return is not met, and therefore the value is going to be destroyed. ROE has to be greater than K. So let me write that down. If ROE is greater than K, which is the required rate of return, then a PVGO is positive. Okay, then the growth opportunities add value for the shareholders. Growth opportunities add value. Okay, investors required rate of return has to be met from firm's investment. The ROE has to be at least 15%. In our previous example it was 20%, so it was meeting this hurdle. So this is the hurdle rate, right? This is the minimum rate that the investments have to earn in order for them to add value for the shareholders. So only if ROE is greater than K will you get a PVGO as positive. Otherwise, like in this example, you will get PVGO as a negative number. All right, so on the slides, I have that same example of partitioning the value into uh, no growth and growth components. Okay, so this is the exact same example that we just worked on with the ROE of 20%. All right, we got the growth rate of 8% in that case, and then we get the P0 as 42.86, and from that we subtract the no growth value and we get the present value of growth opportunities. All right, so there's the same example on the slides that we just worked on. All right, so so far what we have looked at is basically the constant growth model. Right now, in reality, even the constant growth model is unrealistic. I mean, the constant growth model assumes that the same growth rate stays forever, right? But in reality, that's not true. Firms actually grow at different rates. I mean, startups grow at a faster rate, and then as they mature, their growth rate slows down. So there are multiple stages of growth. So a more realistic model would actually incorporate multiple stages of growth. And that is essentially what this discussion is. Remember, the basic idea is still the same. We are taking the present value of future dividends. All right. If we assume constant growth, then the present value of future dividends is D1 over K minus G. But if we don't assume constant growth, if we have multiple stages of growth, things become little bit more complicated. So here in this example, there are two stages of growth, and you have to actually individually compute the present value of dividends in the first stage. And the second stage, you assume that beyond a certain point, the dividends start to grow at that constant rate forever. So that constant growth part actually comes at some point in the future, not starting today, right? So that actually is the difference here. So you are assuming multiple stages of growth. So basic idea is still the same, but I don't want to sort of spend too much time going over this example here. If you're interested, you can actually review this material on your own, but I'm not going to hold you responsible for any calculations related to this multi-stage growth model. Okay, so you're incorporating a higher growth phase here and then a constant growth phase here that is starting after 3 years, right? So you just have to do some additional calculations in order to arrive at the intrinsic value, but you don't have to worry about this calculation for multi-stage growth model.